$10,000 is a lot of money. It can set you up for life if you put it in the right place. You've got $10,000. You just want that money to grow, simply, steadily, without drama. Now, what if I told you that this one decision, where you put that $10,000, could be the difference between barely beating inflation and building over $700,000? Sounds wild, right? But I'm going to show you exactly how that could happen. In this video, we're not playing guessing games. No hype, no generic tips. We're looking at 3 real Fidelity index funds. I'll show you their actual numbers, historical returns, dividend payouts, everything. And by the way, one of these funds could pay you more in monthly income than the average American paycheck without you lifting a finger. So if you think investing is only for the rich, this might challenge what you've been told. Let's break it all down. Chapter 1. Why Fidelity Index Funds? Let's start with the basics. Why index funds? And why Fidelity? Well, index funds are simple. You're not picking stocks. You're buying the entire market in one move. That means less stress, lower risk, and no guesswork. Now here's where Fidelity comes in. Fidelity offers index funds with ultra-low fees, some as low as 0.04%. That matters because high fees eat into your returns, quietly, year after year. In fact, over 30 years, a 1% fee could cost you 6 figures just in fees. Fidelity also gives you easy access, solid performance history, and 0 account minimums. And these aren't tiny funds. We're talking about billions in assets and thousands of companies inside each fund. So instead of betting on one stock, you spread your money across hundreds or even thousands. That's smart diversification. And that's exactly what we want when we're thinking long term. All right, let's look at the first fund. Chapter 2. Fund number 1, FNCMX, Fidelity Nasdaq Composite Index Fund. This one's called FNCMX, short for Fidelity Nasdaq Composite Index Fund. Now, what does that mean? It tracks the entire Nasdaq market, not just a few tech giants. Over 2,800 companies are inside this one fund. Big names like Apple, Microsoft, Amazon, Meta, and Nvidia. Yes, the same companies leading innovation across the globe. Now here's what makes FNCMX really interesting. It gives you exposure to growth-focused businesses. These are companies that reinvest, expand, and scale fast. And when they grow, so does your money. Let's look at some actual numbers. The fund's 10-year return? About 207.77%. That means your $10,000 would have grown to nearly $34,000 in a decade without doing anything, just letting it sit. But what about longer? Well, based on historical patterns, after 20 years, $10,000 could become $180,000. After 30 years, around $349,886. And it doesn't stop there. You also get dividends, cash paid out just for holding the fund. FNCMX has a 0.72% dividend yield, with an average 9.57% dividend growth over the last decade. That's solid passive income that grows while you sleep. Now, the expense ratio? It's 0.29%. Not the absolute lowest, but still way below average, and reasonable for the exposure you're getting. So in short, FNCMX gives you a front row seat to long-term tech growth. Yes, it's a bit more volatile, but if you can stomach the swings, the long-term rewards have been impressive. All right, let's move on to our next pick. It's got even lower fees and a surprisingly strong track record. Chapter 3, Fund number 2, FSPGX. This is the Fidelity Large Cap Growth Index Fund. Sounds fancy, but here's what it really means. You're investing in America's biggest and fastest growing companies. We're talking about large caps like Apple, Microsoft, Nvidia, Meta, and Alphabet. These are companies that dominate their industries, companies with strong profits and global reach. Now, here's why this fund stands out. It's got one of the lowest expense ratios you'll ever see, just 0.04%. That means for every $10,000 you invest, you're paying only $4 a year in fees. That's nothing compared to what you get back. Because over the past decade, FSPGX has returned over 200%. So if you'd put in $10,000 10 years ago, today you'd have around $39,000. That's the power of large cap growth. But what happens over time? Let's run the numbers. After 20 years, that same $10,000 could turn into $158,385. After 30 years, you're looking at over $641,000. And that's without adding another dollar. Plus, you get dividends here too. FSPGX has a 0.45% yield. But what's more impressive is the dividend growth. Over 16% per year on average for the last 10 years. That's your passive income getting bigger each year. So in simple terms, FSPGX gives you elite companies, strong growth, tiny fees, and growing income. It's like owning the top of the market without having to pick a single stock. Now let's shift gears. Our next fund is totally different, and it's built for income and stability. Chapter 4, Fund Number 3, FNARX. Alright, now for something completely different. This one's called FNARX, Fidelity Select Natural Resources Fund. And here's why it matters. Unlike the first two funds that focus on tech and growth, FNARX is all about natural resources. Think oil, gas, metals, and energy companies. So you're investing in real-world, tangible assets. Stuff the world needs, no matter what. Companies like ExxonMobil, Chevron, and ConocoPhillips. Names that tend to shine when energy prices rise. Now, what makes FNARX special? First, it's a beast when it comes to dividends. It has a dividend yield of 3.32%. That's way above average. And over the past 10 years, its dividend growth has been an insane 63.69%. That's not a typo. It means your income from this fund hasn't just grown, it's exploded. But there's more. The 10-year return is 78.25%. So $10,000 would have turned into about $17,800 over that time. And over 30 years, you're looking at about $138,582. And that's not even counting reinvested dividends. Now, let's be clear. FNARX is more volatile. It can have sharp ups and downs. But that's part of the deal with natural resource funds. The upside? It can act as a hedge when tech stocks stumble. Plus, it gives your portfolio some real-world balance. Also worth noting, this fund has an expense ratio of 0.81%. Yes, it's higher, but given the income potential, many investors think it's worth it. Bottom line, FNARX is for those who want income, diversification, and a little more defense in their portfolio. Let's see how all three funds compare when combined. Chapter 5, The Portfolio Breakdown and Results. Alright, now let's put it all together. What if you took that $10,000 and split it across these three funds? Tech growth, large cap strength, and real-world resources. Now, let's talk results. Looking at the 10-year returns, this simple portfolio would have grown to around $30,000 to $32,000. That's tripling your money without trading, timing, or stress. Just a buy and hold approach. But what's more impressive is the long-term potential. Using historical growth rates, in 20 years, this portfolio could hit around $160,000. And in 30 years, you're looking at over $380,000. That's the snowball effect of compounding. And yes, this assumes no extra contributions. Now, let's factor in dividends. Across the three funds, you'd get an average dividend yield of around 1.5% to 2%. That's roughly $150 to $200 a year in passive income, and growing. Remember, FNARX alone has grown its dividends by over 60% in the last decade. So even if the market moves sideways, your income keeps rising. Plus, this combo gives you diversification, tech, growth, energy, large cap, natural resources. That means your portfolio isn't tied to one sector or one outcome. And best of all, you're not paying a financial advisor 1% a year to do this for you. You're in control with just 3 funds. Now, let's wrap it all up. So, what did we learn? You don't need 50 stocks or constant trading or a financial degree. Just 3 solid index funds: FNCMX, FSPGX, and FNARX. Together, they give you growth, income, and diversification, with low fees and a strong long-term track record. Now, of course, nothing is guaranteed. Markets rise and fall. But if history's any guide, patience wins. $10,000 today could become over $380,000 in 30 years. That's not hype. That's math. And honestly, if your bank gave you that kind of return, you'd call it a scam. But the real scam? Leaving your money in savings, earning 0.01%. So don't overthink. Start small. Stay consistent. The earlier you begin, the harder your money works. And if you've already started, great. Just keep going. Thanks for watching. Now tell me in the comments, which fund would you invest in first? Let's get the conversation going.